Right, now we go to London and we talk about asset allocation. Tristan Hanson is the head of asset allocation at Ashburton in the capital of the United Kingdom. Tristan, thanks very much for joining us. So much going on at the moment in the South African market about asset allocation, people talking about getting out of domestic and industrial stocks and going into maybe resource-based stocks with a rand hedge element. What are you doing at Ashburton?
Well, we're fairly neutrally positioned at the moment. We're trying to look for opportunities in select markets around the world across the various asset classes. So we'd sort of be neutral in equities here. There's been some good news from the ECB and the Federal Reserve, but we think markets have run pretty quickly over the last month or two. And we're heading into an earnings season that might be quite difficult. And there are a number of risks on the horizon still in terms of the US fiscal cliff. And also, we're not out of the woods yet in the Eurozone. Having said that, we do recognise there's been some good news in terms of equity markets. In terms of bonds, we're looking at select emerging markets such as Mexico, Malaysia, and we still have a preference for corporate bonds, in particular high yield, over developed market government bonds, which we continue to think are going to offer poor returns over the medium term.
Of course, this is Tristan. It's Alicia in Johannesburg joining in on the conversation now. And, you know, this is in a context where there's a lot of uncertainty as to where we're headed next. I mean, lots of questions with regards to quantitative easing, not only in the US, but what we've seen filter through out of Europe, out of Japan as well. What's your view on that and the kind of implications that has for the broader economy right now and how that's influencing your investment strategy?
Yeah, well, these measures are important, but they, in terms of the very short term, they don't have any immediate impact on the economy, only through whether they get asset prices higher, which can then have a knock-on effect to the wider economy. So in the near term, very little economic effect. I think of the three measures, I'd say that what the Bank of Japan has done is the least significant. I don't think that really will have very much effect at all. In terms of the most significant, I think the moves out of the ECB are a very positive development, but as I say, we're not out of the woods yet, because before the ECB triggers these bond purchases, we're still reliant on the likes of Spain or Italy to ask for help from the EFSF. Now that bond yields have fallen, they may not feel inclined to do so, given their unwillingness really to be seen to be requiring a bailout.
Tristan, give us your sort of verbal pie chart of your asset allocation. I mean, if someone gave you 100, whatever it is, euros today, how much would you allocate to equities, how much to bonds, how much to cash, how much to whatever? I mean, and be brutal here if you would, because you've sort of suggested that you think that maybe the market is looking a bit full at the moment, certainly from the equity point of view.
Yeah, sure. So if I talk in terms of, I mean, clearly we run very different risk profile funds, so it will vary depending on how aggressive one wants to be with their overall allocation. But if we look at our largest fund, which is the Replica Asset Management Fund, this is quite a cautious mandate. We have a maximum of 50% in equities in this fund. In terms of current positioning, we're around 27–28% in equity and equity-related assets. We then have around 45% in emerging market debt and corporate debt, no exposure to developed market sovereign debt, and then we have quite a high cash and cash equivalent holding just at this present point in time.
With that emerging market, or equity focus rather, to what extent are you focusing on multinational companies with exposure to emerging markets as well? That kind of theme that seems to carry through to where you're allocating in terms of bonds.
In terms of bonds or in terms of equities?
In terms of equity, so you've got a theme going on where you've dedicated assets or allocation towards emerging market bonds specifically, as opposed to government bonds in developed economies. If we take that theme through to the equity side of your portfolio, to what extent are the equities you're looking at right now multinationals with emerging market exposure as well?
Yeah, that's very much the case. I mean, in terms of the various themes that we're running within our equity portfolios at the moment, probably the strongest theme is a death of cheap oil supply theme that we're running. This has been a long-held theme of ours whereby the marginal cost of oil production has been rising over time, and we expect the oil price to remain quite elevated by historic standards. This is largely a supply side issue rather than demand side issue, because the cost of extraction and particularly given oil depletion, it's becoming very expensive to source new oil, and therefore we play this theme actually perversely, you might think, given that oil demand is coming increasingly from the emerging world, but we can play this theme through, in particular, Norwegian and other European stocks that are the leaders in this field. In terms of other themes we have as well, I mean, relative to the Western world, we think the US economy is on a better footing, so we look for exposure, doesn't matter where the company is based, but within the developed world we look for exposure to the US, so whether that's a preference for US banks over European banks on a medium-term view. And then we also think that we're in quite a difficult world environment, so we like stocks that can continue to grow their dividends and have a sustainable yield. Within our developed exposure, of course, there are other themes geared to the emerging market consumer, so that's correct, yeah.
Tristan, tell us about your view on South Africa at the moment. You've obviously seen what's been playing out in the mining sector of our economy, and it's gone from the back pages, the business pages, to the front pages. When you say you're 45% exposed to emerging market debt and corporate debt, how much of that is South African, and how much has the mining sector crisis affected your view on our economy and our country and our markets?
Yeah, clearly it's a very important issue. In terms of our exposure to South African debt, we've got a very small exposure in some corporates and also the sovereign, but in hard currency, so in the region of 4 to 5% exposure there. And you would expect with the news that we've had a slight widening in the risk premium for South African assets versus other emerging assets because of this South African specific news. Interestingly, the currency hasn't been that affected, although it has lagged some other emerging market currencies. But I think clearly it's an issue going forwards, and the question is whether this will prove a more sustained trend or whether it is a more isolated incident.